In the last 90 days, something unprecedented happened in the financial world. It wasn't a crash, it wasn't a rally, it was an exodus. Warren Buffett, the greatest investor of our time, didn't just sell some stock. He liquidated over $600 billion worth of assets. He is now sitting on a cash pile of $334 billion, the largest war chest in the history of Berkshire Hathaway. But he isn't alone. Jeff Bezos just sold $8.5 billion of Amazon. Jamie Dimon, the CEO of JP Morgan, sold stock for the first time in 18 years. The Walton family sold $4.5 billion of Walmart. The mainstream media tells you this is just profit-taking. They are lying. The smartest money on earth doesn't move to cash because the economy is strong. They move to cash because they see a storm on the radar that you don't. They see a mathematical deadline that hits the global economy in exactly 18 months. There is a specific date when the free money era officially ends. There is a specific amount of debt, $1.5 trillion, that triggers a default cycle we haven't seen since 2008. We are standing on the edge of the greatest wealth transfer in human history. The insiders have already sold. They're out of the building. And if you are still holding the bag when the clock strikes 2026, you will be the one paying for their exit. This is the story of the 2026 reset. This is what they aren't telling you. And this is how you survive it. To understand why the billionaires are fleeing, you have to look at the foundation of the American economy, real estate. But not your house. We are talking about the massive steel and glass towers that define our cities. Commercial real estate, or CRE. Right now, there is $5.7 trillion in commercial real estate debt sitting on the books of U.S. banks. But here is the problem. Commercial loans aren't like your 30-year mortgage. They're short-term. They act like a balloon. Every 5 to 7 years, you have to pay them off or refinance them. Between now and the end of 2026, $1.5 trillion of these loans are coming due. Let me explain the math that is keeping bankers awake at night. Most of these loans were taken out in 2020 and 2021. Back then, interest rates were near zero. A developer could borrow $100 million at 3% interest. The payments were easy. The building was profitable. But today, to refinance that same loan, they have to pay 7% or 8%. The interest payments have tripled, but the income from the building hasn't. In fact, it's collapsed. Office vacancy rates in major cities are hitting 20, 30, even 40%. So the landlord is facing a nightmare scenario. The building is worth half of what he paid for it, and the cost to keep the loan has tripled. He has three options. Option 1, he writes a check for $50 million to pay down the principal. He doesn't have the cash. Option 2, the bank pretends the building is still worth $100 million and extends the loan. This is called extend and pretend, and it's happening right now. Option 3, he walks away. He hands the case to the bank, default. We are already seeing option 3 explode. In Los Angeles, one of the largest office towers sold for 52% less than its purchase price. In San Francisco, buildings are selling for 75% off. But here is where it gets dangerous for you. Who lent them the money? It wasn't JP Morgan or Bank of America. It was the regional banks, the small to mid-sized banks where you keep your savings, your payroll, and your business accounts. Regional banks hold $2.7 trillion in commercial real estate loans. That is nearly 50% of their total assets. Right now, these banks are sitting on $516 billion in unrealized losses. Unrealized is a fancy accounting term for we lost the money, but we haven't admitted it yet. They are hiding these losses in the footnotes of their balance sheets, hoping interest rates go back down. But Jerome Powell has made it clear, rates are staying high. The wall is hitting in 2026. And when $1.5 trillion of loans default, those unrealized losses become realized. The banks will not just lose money, they will become insolvent. Buffett sees this. He knows you cannot hide $500 billion in losses forever. He knows the banking crisis of 2023, Silicon Valley Bank, First Republic, was just the tremor. The earthquake is scheduled for 2026. You might be asking, if the banks are in such bad shape, why haven't they collapsed yet? Because the government rigged the game. After Silicon Valley Bank failed in 2023, the Federal Reserve panic printed a safety net. They created something called the BTFP, the Bank Term Funding Program. This program allowed banks to take their underwater assets, bonds that had lost 20 or 30% of their value, and loan them to the Fed for 100 cents on the dollar. Imagine if you bought a car for $50,000, crashed it, and it was now worth $10,000, but the dealership let you trade it in for $50,000. That's what the Fed did. They bailed out the banks without calling it a bailout. But there's a catch. The program was temporary. It expires in March 2025. In 4 months, the safety net gets cut. The training wheels come off. Banks will no longer be able to hide their toxic assets at face value. They will be forced to mark them to market. This is the first domino. March 2025 removes the life support. Then the maturity wall of 2026 hits the patient. The timing is mathematical. It is inescapable. This is why Blackstone, the largest landlord in the world, has raised $30 billion in cash specifically for distressed real estate. They aren't buying buildings today. They're waiting for the banks to fail so they can buy your city for pennies on the dollar. This is why JP Morgan just moved $247 billion out of securities and into cash. The big players are positioning themselves on the sidelines. They know that when the BTFP ends, the truth comes out. And the truth is that hundreds of regional banks are technically bankrupt. If this was just a US real estate problem, we might be able to print our way out of it. But it's not. The trigger for the 2026 collapse isn't in New York, it's in Tokyo. For 30 years, Japan has been the ATM of the world. The Bank of Japan kept interest rates at 0% or negative. They printed unlimited yen. This created the greatest financial arbitrage in history, the yen carry trade. Here's how it worked. Hedge funds and Wall Street banks would go to Japan and borrow billions of yen for free, 0% interest. They would then convert that yen into dollars. Then they would take those dollars and buy US stocks, US bonds, and US tech companies. It was free money. It inflated assets all over the world. It is estimated that $20 trillion of global financial assets are supported by cheap Japanese money. Your mortgage rate, the price of Nvidia stock, the value of Bitcoin, all of it was artificially boosted by the yen carry trade. But in 2024, the ATM stopped spitting out cash. Inflation in Japan hit 3.5%. The Japanese people were angry. The cost of living was skyrocketing. So the Bank of Japan did the unthinkable. They raised interest rates. They turned off the machine. And now, the trade is reversing. When Japan raises rates, the yen gets stronger. When the yen gets stronger, those hedge funds that borrowed yen suddenly owe more money. They are facing margin calls. To pay back the Japanese banks, they have to sell their US assets. They have to sell Nvidia. They have to sell US treasuries. They have to sell gold. We saw a preview of this in early August. Japan raised rates by a tiny amount, 0.25%. The US market collapsed. The Dow dropped 1,000 points in a morning. Imagine what happens when they raise rates to 1% or 2% to fight inflation. It triggers a global liquidity drain. Just as the US banks are hitting the real estate wall, the foreign capital that supports the US stock market is being pulled back to Japan. It is a double pincer movement. Domestic debt implosion from the inside, foreign capital flight from the outside. This is why Warren Buffett is selling. He understands global flows better than anyone. He knows that the everything bubble was funded by the yen, and the yen is going home. But zoom out. Why is this happening now? Why 2026? Because we have reached the mathematical limit of a debt-based system. Our entire financial model is based on a lie created in 1694 by the Bank of England and perfected in 1913 by the Federal Reserve. The lie is that you can borrow forever as long as you can pay the interest. Governments don't pay off debt. They roll it over. They borrow from Peter to pay Paul. This works when debt is low. It works when interest rates are low. But today, global debt is $315 trillion. That is 3 times the size of the global economy. The U.S. national debt is $38 trillion. We are adding $1 trillion in new debt every 100 days. Here is the death spiral. Because interest rates rose to fight inflation, the interest on that debt has exploded. The U.S. government is now spending $1.1 trillion a year just on interest payments. We spend more on interest than we do on the entire U.S. military. We spend more on interest than we do on Medicare.
This is the event horizon. When a government has to borrow money just to pay the interest on the money it already borrowed, the game is over. It leads to one of 2 outcomes. 1, hard default. The government admits it's broke. The system collapses. Unlikely because they own the money printer. 2, soft default. Hyperinflation. They print the difference. They devalue the currency so that the debt becomes worthless. History tells us they will choose option 2. They will print. But before they print, there is always a deflationary crash, a moment where the debt bubbles pop. That is the 2026 scenario. First, the debt bubble in real estate pops, deflation. Then the banks fail. Then the government panics and prints trillions to save them, inflation. The smart money is preparing for the first part, the crash. That's why they want cash. Cash is king during a crash. It allows you to buy real assets, factories, land, commodities, AI infrastructure for pennies. Then, when the printing starts, those assets skyrocket in value. This is the great wealth transfer. It is a mechanism. It transfers wealth from the passive investor who holds a 401k and ignores the news to the active investor who holds cash and waits for the bottom. I want to give you the specific timeline. This is not a prediction. This is a projection based on the maturity dates of the loans and the expiration of the Fed programs. Phase 1, the warning, now to late 2025. We are here. The insiders are selling. The gold price is hitting all-time highs. Central banks buying protection. You will see more headlines about unexpected weakness in the labor market. You will hear about regional banks seeking mergers, which is code for bailouts. Action item: this is your window to build liquidity. Phase 2, the fracture, Q1 to Q2 2026. The BTFP is gone. The first wave of massive commercial real estate loans comes due. We will see a major headline, likely a well-known skyscraper or a hotel chain filing for bankruptcy. The stock market will likely test its highs one last time, sucking in the retail investors while the foundation cracks. Phase 3, the event, Q3 to Q4 2026. The dominoes fall. A mid-sized bank will fail, but this time the Fed won't be able to save it easily because inflation will be sticky. Panic spreads. Margin calls hit the stock market. The S&P 500 could drop 30 to 40% in a matter of months. Unemployment spikes to 6 or 7%. This is the moment of maximum fear. The media will say capitalism is ending. Phase 4, the reset, 2027. The government intervenes. They will introduce a digital dollar, a CBDC, or a massive stimulus package to reset the system. The printing presses will run hot. Asset prices will bottom and then rip upwards. This is where the billionaires deploy their cash. Blackstone buys the apartments, Buffett buys the companies. If you have cash here, you win. If you are fully invested in declining assets, you lose. So what do? Panic is not a strategy. Preparation is. You need to stop thinking like a consumer and start thinking like a distressed asset fund. Step 1. Audit your bank risk. Do not keep more than $250,000 in any single regional bank. If your bank has heavy exposure to commercial real estate, move your funds. The too big to fail banks, JP Morgan, BOA, are safer because the government effectively guarantees them. Step 2. The dry powder doctrine. You need cash, not to bury in the backyard, but to deploy. Most people are 100% invested. They have no ammunition. When the market crashes 40%, they can only watch. If you are 20 or 30% in cash, short-term treasuries, or high-yield savings, you are a predator. You are waiting for the sale. Step 3. Hard assets. When the reset happens in Phase 4, they will print money. Paper money loses value. You want assets that cannot be printed. Gold, silver, land, Bitcoin. These are insurance policies against the currency debasement that follows the crash. The central banks are buying gold at the fastest pace since 1967. Do what they do, not what they say. Step 4. Quality over speculation. Sell the junk. If you own companies that don't make a profit or crypto coins that have no utility, get out. In a high interest rate environment, growth at all costs dies. Profit and cash flow survives. Own companies that sell things people need, not things people want. Energy, healthcare, defense, food. The cycle of history is ruthless. 1929, 1971, 2000, 2008, 2026. Every 18 to 20 years, the system purges itself. It punishes the arrogant, the leveraged, and the blind. It rewards the disciplined, the patient, and the prepared. We are walking into the dark. The signs are there. The smartest men in the room have already cashed out. They aren't waiting for the evening news to tell them it's over. They are waiting for the dust to settle so they can buy the world back from you at a discount. Do not let them. You have the information, you have the timeline, you have the warning. The coming crisis is not the end of the world. It is a transfer of ownership. The only question is, will you be the one transferring your wealth away or the one receiving it? I'm going to track every single step of this collapse on this channel. When the first bank cracks, I will tell you. When the yen carry trade snaps, I will break it down. When the bottom is in, I will let you know. But you have to be here to see it. Don't be a victim of the algorithm, be a student of history. Click that subscribe button, turn on the notifications. The storm is coming. Let's get ready.